வணக்கம். Accounting concepts. The concepts are otherwise called postulates or principles. The first concept in accounting is entity concept or business entity concept. According to this concept, the business is different from the owners. The transactions are recorded for the business and not for the owners. So, whenever a particular transaction is made by the business, whether it is related to the owners or outsiders, it is treated as for the business. This is the basic assumption. Take the case an example. When capital is introduced by the owner or owners or the proprietors or the shareholders to the business, it is treated as a liability to the owner or owners, and the owners or owner is treated as creditor or creditors. Now, whenever the owner or owners are withdrawing money for their personal use, it is treated as drawings, and this is an expense to the business. So, whatever may be the entity means the form of business, that may be proprietorship, partnership, or a company. It is treated separately, and accounts are prepared for the business only. Second concept is dual aspect concept. This concept is based on an equation, that is assets equal to capital plus liability. Here the total liability is divided into two. Capital, that is the capital refers the amount introduced by the owner or owners, plus outside liability. So here the liability refers the outside liability. Now we will discuss with an example. Started business with cash rupees 1 lakh. This transaction is recorded in two aspects based on this dual aspect concept, that is asset equal to capital plus liability. Here asset is the cash, that is the amount introduced into the business as cash, and that is equal to capital plus liability. This 1 lakh is introduced into the business as capital, so asset 1 lakh equal to capital 1 lakh plus liability is 0. So here the asset equal to capital plus liability is taken as an equation, and this particular equation is also called balance sheet equation or concept of balance sheet, and this is the base for preparing the balance sheet in accounting. Now we will see the third one, going business or going concern concept. According to this concept, any business is started for a fairly long period of time, and it is not started with an intention to close it immediately, unless and until the business is closed due to an unexpected or after a long period of time. And accordingly, all the assets are purchased for a long period of time only. Remember that according to this concept, irrespective of the existence of the promoters of any business, the business exists forever unless it is closed for a particular reason. Now we will see the fourth concept, that is money measurement concept. As per this concept, accounting is made for any transaction in terms of money only. Every country has its own currency, and in that particular country, the accounts are prepared and recorded in their own currency. All the events or transactions which cannot be expressed in terms of money are not recorded in the books of accounts, even if they are very important or useful for the business. For example, high quality machinery is purchased. You cannot record the high quality. You have to write the value of that in terms of money. Now we will see the fifth concept. Fifth one is cost concept. According to this concept, whenever assets are purchased, the cost of purchase only will be recorded as the value of that particular asset. This concept does not recognize the realizable value or the replacement value or the real worth of an asset. For example, we are purchasing one piece of land at 10,000 rupees. Now, after 5 years, in the books of account, it will be only in 10,000. The market value of the asset will not be considered. That market value may be 50,000 or even less than 5,000. So, this particular concept has some objections and criticisms. Now, we will see the cost attached concept. The cost attached concept is also known as cost merge concept. When a finished goods is produced from the raw material, there are certain process and costs which are involved, like labor cost, power and other overhead expenses. This particular concept is applied to find out the cost of that particular product. The next one is accounting period concept. This particular concept refers the accounts are prepared for a definite period of time only, normally 1 year. In India, the accounting period is April 1st to March 31st. Now we will see the accrual concept. According to this concept, revenue and expenses accrued for a particular period is recorded whether or not received or paid. Example, commission earned, rent unpaid. These are recorded on accrual concept basis. The next one, that is the ninth one, is period matching of cost and revenue concept. To ascertain the profit made during a particular period, it is necessary to match revenues of the period with the expenses of that period. Income or profit earned by the business during a period is compared with the expenditure incurred to earn that particular revenue. Here, the total income equal to total expenses plus profit or minus loss. The 10th one, realization concept or revenue recognition concept. According to this concept, profit should be accounted for only when it is actually realized. Revenue is recognized only when sale is effected or the services are rendered. Simply receiving of cash does not mean revenue is recognized. It must have earned. Now we will see the 11th one, verifiable or objective evidence concept. According to this concept, all accounting transactions should be evidenced and supported by objective documents. These documents may be invoices, contract, correspondence, vouchers, bills, passbooks, check, etc. Hope that we understood the simple meaning of all these concepts. Thank you.